I'm recording now, you guys, so it's just sound, not anything else. So, we're doing problem 1110 because it's a tricky one for a lot of students. There's a couple challenging parts, and when we get to them, I'll talk to you about them. You probably wouldn't see it quite that hard, but I wanted to give you an indication of where these problems can go. Okay? So, problem 1110, who's all read it in preparation for class? I understand, yes, I understand. I was a student also. So, I'm just going to I'll just summarize it. Victoria Textiles opens an Asian 100% owned business. And they can buy and sell with other divisions of the company, and it's an autonomous kind of independent unit. So originally they gave 10 billion Indian rupees, January 1st, year 2. It was successful, did better, however the rupee fell in value compared to Canadian quite substantially. As a result, well, they're confused, so we have to help them. So, what they give you is the financial statements, and they give you year 3 and year 4. Sometimes you just get year 4 and the year 3, any information you need. Like when you've gone through the notes and you've practiced calculating the gain or loss, it's in the additional information. Okay? Here, on the second page, it's got the income statement, and let's remember this is year 4. The income statement which is also for year 4. It's kind of light. We don't care so much about year 3. Our focus is always year 4. So, we want a Canadian dollar balance sheet. It's always going to be that, December 31st, year 4, and an income statement for year 4, assuming 2 things. VTIL's functional currency is either the Canadian dollar or the Indian rupee. If their functional currency is the Canadian dollar, are they integrated or self-sustaining?
Integrated.
Integrated, okay? So these guys are going to be integrated. So which method do we use when they're integrated? CT, you'd think they'd use different names to keep it a little clearer, but no. Functional. Okay, so we're going to use FCT. And just so you know, that's also called the temporal method. And the reason I'm telling you, it's just in the last couple of years, right? This is all in response to IFRS. So you guys are heading out into the work world soon, so you could hear that. So that means if it's the Indian rupee, they must be integrated, or what's the other one? Self-sustaining. So presentation, currency translation, which is also called the current rate method. Now, they give a note, insufficient information to translate retained earnings and accumulated foreign exchange adjustments. So you have to plug in the balance sheet. Okay? Now, part B, which method should they use? Given everything up front in the original information, you can just look at that in the solution. It's a nice little thing to think about. Okay? I'd never leave a question open on an exam where you had to pick the right one, right? And it could have been wrong. So if I wanted to know, are they self-sustaining or integrated, that would be a separate question. Okay. So here's all the additional information. Now, we need to know exchange rates on different dates. Okay? Now, what you're going to refer to, you guys, it becomes your little Bible for this chapter, is on page 3 of the notes. So if you have your notes handy, page 3, it's also in the text. But here's my little scribblings on it, which we when. Okay, this little table pretty much is everything you need. Okay, so always refer back to that. So we're going to refer to page 3 of the notes to the table. Now, let's just go through some of this additional information so we kind of get an idea of what's there. Exchange rate January 1st, year 2, when it was originally established, we've got an exchange rate here. Of the original investment, $4 million was used to acquire on a straight line basis over 10 years. So, how much depreciation is that per year? Remember, these are all in thousands. So it's 4,000 divided by 10 is 400 per year. Depreciation for this little piece. This one's tricky. A number of the other questions just say, here's the assets, and you go with it. Okay, and I'll just put a note here, it's in thousands. And actually one more little note, just because sometimes connect isn't clear and students and humans for that matter, any of us, look at it and go, well, what exactly do they mean? If it says, oh, I want to save space up there, let's do it down here. Put 4 million, right? But if it's in thousands, you take the last 3 off, and you'd put 4,000. Okay? Does that make sense? Okay, so going back here. Now, June 30th, year 3, so we're dealing with something else. There was an expansion. And it was financed by a note. Interest is paid semi-annually. Exchange rate at year 1, July 3rd, was 0.062. So, exchange rate. The new expansion is also to depreciate on a straight line basis over 10 years. Half year's depreciation was recorded in year 3. So then it tells you total for and that much in year 3. Okay, so inventory is accounted for on the FIFO basis, which pretty much, you guys, in this whole course, we assume first in, first out, and when we get to consolidations, it will really make a difference. Tells you when end of year 3 and end of year 4 inventory was acquired, and it tells you, again, we've got exchange rates. Sales, purchases, and operating expenses were incurred evenly throughout the year. What does that tell you right off the bat? What kind of rate can you use? Average rate. Now, often they don't have that in the rest of the sentence, but the average exchange rate, there's another rate you got to pay attention to. Prepaid expenses and unearned revenue, and this is an unusual seeing a problem. That's why I'm starring it. Those in the exchange rate should point to K. It's what we have to do with them to figure out the gain or loss. That's the issue. Okay? So I'm going to put, watch for these on gain or loss for FCT. Okay, income tax paid in monthly installments, so that means we can use average. Dividends were declared and paid each year on December 31st, and their exchange rates are down here. Rates are here. Notice they didn't show this, but it would be 1, I think it's INR, equals that. So that's what it's assuming. Okay? Everybody good? Okay, don't worry, we'll... So what I want to go back and do is actually start doing the rates. Too much paper here, you guys. And we're going to do the rates. So bearing in mind this is FCT. So our general rules for FCT are, notice there's one closing and a bunch of historical in that. Only monetary net assets are at closing. So that's something, that's a nice way to remember it. Monetary net assets at closing. Everything else at some kind of So first let's determine what they're each going to be. Cash, is it going to be historical or closing? Monetary? Definitely. So it is at closing. And I'm just going to write closing or whatever, then we'll find the rates. Accounts receivable? Closing. Okay, inventories is monetary too, isn't it? No, why not? We sell inventory, we get money. Why isn't it? There's no right, okay? You can't force the people. Good if you were in some kind of cartel somewhere else, but not here. So inventories are going to be historical. And we look at our little chart. Non-monetary at cost or amortized cost is historical. So just plain old historical. So it's going to be when purchased. Now, this is a unique situation also. The parent company started this subsidiary. So when it started was when all the transactions started. If you've done other questions or gone through the notes, you'll see that often maybe the parent buys them in year 5. So they might have plant and equipment. Can we go back to year 2 if we only owned them at year 5? No. So the minimum date we could use is the year 5 date. Okay? So just watch for that. You can get either situation. Okay. Prepaid expenses, are they monetary? No. You can't force them to give you your money back if you paid rent in advance. So, when purchased. And a lot of times it's just acquisition date. Now, the plant assets. are a bit trickier. Because when do we do plant assets? They're non-monetary at cost or amortized. Okay? And it's when they were. So this is historical when purchased. Except, do we have just one asset? A lot of questions just assume you just got one asset. Who cares? It was the beginning when they were acquired. But in this one, we had the original build, year 2, beginning of year 2. And then partway through year 3, we had the additional capital. Okay? So we're going to have to split this into 2. So there's 2 distinct assets here. Now, how you know when to split it is when they start giving you detailed information about these assets and when exactly they were purchased and how much depreciation is for them. That's when you have to do more thinking. Okay, so let's look at our 2. No, you know what? We're going to split that later. The key thing is we're going to put our number in when purchased. Okay, I want to go through and get this straight. I thought a lot about this last night, how I wanted to present it, but hopefully this will work. Okay, going down, we're trying to find if it's monetary or non-monetary. How about current monetarities? Clearly, yes. So they are at closing. Unearned revenue. Is it monetary? Nope. So it is historical. And long-term debt, is it monetary? Yes, because you're going to get money, or get or give money. It'll be settled with money. So it's closing. Common shares. So for that, look at our little chart. Because notice we're moving away from assets and liabilities, and that hits equity. So equity is always a little bit different. Common shares when issued. So historical. And in this case, it's not before we acquired them. Some other questions, they would have issued common shares in year 1 and we bought them year 8. We can't go back to year 1, we have to go just to year 8. Okay, so common shares when issued. And retained earnings, we're going to do a calculation for it. So, I want you to take a couple minutes and go through and try and put the exchange rates with. And it's a little tricky because they're spread all over the additional information. And let me know if you have a question.
Yeah.
Oh, yes. I couldn't just yes, you can make it work. The first time ever.
We'll get it fixed out.
How are you guys doing? You got all the little ratios? Who's excited about accounting? Anyone? I know, it's been 4 long years, right? Interestingly, one of my students, I remember she emailed me, oh, she'd been working at, I can't remember which firm she was at, for a week. And the first thing she had to do was translate financial statements from foreign currency to Canadian. She goes, I'm using everything I used in advanced. I'm going, oh my God, thank goodness someone is. Okay, so what do we closing? Closing rate for cash. Anyone? 0.025. So this is 0.025. Down here, 0.025. And down here, 0.025. You'll notice the more questions you do in this text, IFRS suggests we flip statements backwards. So it's kind of backwards. So arrange it in different ways. So when you're doing this, be really careful. And I only say that because I was doing this last night and I was going, oh yeah, long-term debt, historical, what date was it in? I'm going, something's wrong. Oh yeah, it's monetary just because it's down there. Anyway, I do know accounting, you guys. I do. Okay, how about inventories when purchased? When were these inventories purchased? 4 was acquired at, what was the rate? 0.027? Everybody got that? Okay. Prepaid expenses, they were also given at 0.03. I hope this is lining up, you guys. And then, of course, you're going to multiply all of these. I'm not going to do it right now. Okay, now we get to 2 sets of assets. We're not going to figure out the numbers right now, but I do want to put the rates. So when were our 2 pieces of assets built or started using? Well, one of them, the 4 million one from bullet point 2, was of the original investment, which was January 1st, year 2. So what's the rate on January 1st, year 2? You got to do some searching. .075. So there's 0.075 from January 1st, year 2 for one of our assets. And the other asset was built in June 30th, year 3, the 3rd bullet point. And it tells you the exchange 0.62. Okay, everybody got on the exchange rates. Okay, how about unearned? It was given, right, in point 1, 2, 3, 4, 5, 6. So bullet point 6 was 0.028. And the common shares were when issued, which was January 1st, year 2, so it was 0.075. Okay, I'm going to come back to the calculations. I mean, they're pretty straightforward, except for plant assets. I just want to continue with our income statement. Okay. Anyone still need this? Okay, so the income